Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
All right, welcome everyone. Welcome to the Poole Locke YouTube channel. I'm James Locke, and today we're going to answer some of the Ask James questions of the day. We have this question from Diane. She says, we invested in real estate on the advice of our financial advisor, but now everything is worthless. We were devastated. So we thought that it would never happen to us and we would never take a complete loss. What can we do now? All right, Dan, what happened here? Well, I'm only going to guess, but my suspicion is your financial advisor put you into probably a non-liquid investment. There are non-liquid real estate investment trusts where you're invested in real estate, but it's not liquid. So you put your money in, and they promise that in 5 or 10 years they're going to have a liquidity event. They're going to sell out, they're going to do an initial public offering, and you're going to get back your money plus a huge capital gain. But sometimes, of course, it goes the other way. The other thing that you may have thought of as a real estate investment is this real estate limited partnership. Now, back in the day, those were popular maybe in the 80s and 90s, right? Same thing, illiquid. Most liquid real estate investments aren't going to go to zero, right? It's not going to be a complete loss. So, Dan, the fact that you said it went to zero, I'm guessing, or became worthless, I'm guessing that it is a illiquid investment. And I will tell you, I'm not a fan of those. There are some investments that commit to time frames, like bonds, preferred stocks, annuities, CDs. They have time frames, and they're still liquid. You might just have a penalty if you liquidate, but if you're talking about an illiquid investment, Diane, I know it's maybe too little too late, but I'm a big fan of staying away from those. By definition, when you have a lack of liquidity, if something starts to have financial trouble, you don't even have the opportunity to sell it at a loss even, because you're stuck there. And that investment may have been diversified, among different properties, but it might have been managed by one manager, and that manager failed in their job to manage the real estate investments appropriately. So stay away from things that are completely illiquid. That's a great general rule, in my opinion. When it comes to investing for income in retirement, I always recommend sticking to more liquid, transparent investments that provide a steady stream of income. Bonds, dividend-paying stocks, real estate investment trusts that are liquid, and annuities, right? These types of investments can help ensure your retirement income remains stable and predictable, even in turbulent market conditions. Diane, thanks so much for sending in your question. I know these types of situations can be very frustrating, but I hope this advice helps provide some clarity on what to avoid and what to focus on for your retirement investment going forward. That is an awesome question, a good learning experience. As always, if you'd like to send in your questions, you can do so by emailing them to us at poolelock@poolelock.com. Moving on to our second question. This is from Bill. He says, I'm diversified, so I'm not really as worried about a total loss, but how can I figure out if my risk from volatility is appropriate? All right, Bill, so how can you figure out if your risk from volatility is appropriate? Well, that's a great question. First of all, Bill, I don't know anything about your specific situation. I don't know if you're retired, or if you're not retired, what your portfolio looks like and things like that. But one of the biggest mistakes that people make is they look at the last major market downturn and assume that their risk tolerance is the same as it was back then. For example, the last time we had a truly major drop was 2008, 2009. But Bill, you like just about everybody here watching this show, we're at a different stage of your life, right? So it's one thing to say, oh, that didn't bother me back then, because back then you were contributing to your 401k. You were younger, you were dollar cost averaging. So you may have even, seen the market drop as an opportunity to buy more shares at lower prices. But now, if you're retired or close to retirement, your risk profile and your need for income stability is very different. The most you could reasonably take, in my opinion, is a 4 to 5% kind of drop in your portfolio value per year. So if you have $1 million portfolio, the most you could comfortably withdraw for income is $40,000 or $50,000 annually. And that's only if your portfolio is perfectly allocated for income generation. So there's the left brain mathematical part of it, looking at how much volatility your portfolio can withstand while still providing the income you need. But there's also the right brain emotional component. Even if the math says you can absorb a 20 to 30% drop, how would that actually make you feel? Would you still be able to enjoy your retirement? Or would you be constantly, be anxious at the state of your investment? The key is finding that sweet spot in the middle, where the volatility risk is low enough that you can sleep at night, but high enough that you're still generating the returns you need. It may take some trial and error and perhaps working with a financial advisor to dial in the right asset allocation and risk profile for your specific situation and stage of life. So Bill, I hope this helps, provide a framework for evaluating your own portfolio volatility risk. And let me know if you have any other questions. I'm sure we'll be diving deeper into this topic in future Ask James episodes. Thanks for the awesome questions. And as always, if you'd like to send in your question, you can do so by emailing them to poolelock@poolelock.com. If you like what you heard, go ahead, like and subscribe to our channel. I'm James Locke, your retirement income source. See everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.